times like these, it seems like most stocks and ETFs are either continually going down or week after week have very flat returns. This year especially, there's not only been negative year-to-date growth, but as of the past couple of weeks and even months now, it really does seem like all those popular growth and S&P 500 ETFs are moving as slow as a snail.
Slow down! I want to get there, but I want to get there alive!
But with that being said, there are a handful of ETFs that have recently been rapidly growing, even in times like this, when the S&P 500 seems to be at a screeching halt. So we're going to go over a few of those ETFs today, starting with the first one, which is a gold ETF called IAUM. Now, gold, as we know, has historically been a very safe haven type of investment, and when the economy is very volatile and stocks are kind of jumping up and down or falling, gold tends to hold its value in a very rock-solid way. And if you have been following the price of gold, you might have noticed that it's up nearly 40% in the past year. Now, we haven't necessarily been in a stock market recession for over a year now, but year to date, as we know, stocks have been completely taking a beating while the price of gold continues to rise. Which is why I think IAUM is a great way to hedge by holding gold long term, and especially during market recessions. And what I specifically like about this ETF is that it's fairly small cap with a very low expense ratio of 0.09%. So it's a really simple and easy way to own and have exposure to the value of gold without having to go out and actually buy physical gold bars and keep them in a safe in your house. Which brings me to the next ETF that I think is a great one to own, especially during market corrections. It's called SHLD, or the Global X Defense Tech ETF. Now, this is a fairly new ETF launched back in September 2023, and it consists of some of the top defense technology innovation companies. So in this portfolio, you might find companies such as RTX, formerly known as Raytheon Technologies, Palantir Technologies, and Lockheed Martin. Now, a lot of these companies, including Palantir, have just exploded over the past year and are still in the green year to date. Palantir is up 24% this year, while the Nasdaq is still down 13%. So you might be wondering why a fund like this defense tech ETF continues to rise as the broad market has hit more of a slowdown. So kind of the main reasons why is we've had pretty hefty tariffs put in place, which then caused rising geopolitical tensions as well as national security concerns. And as all this international drama continues, it creates steady demand for the companies held in SHLD's portfolio. So needless to say, this ETF has been consistently growing for multiple years in a row, with a one-year return of 57% and a year-to-date return of over 35%. So another great example of a fund or specific sector that tends to do well during market recessions. Now, with it being pretty new, it's a fairly small fund with an AUM of 1.55 billion and a slightly above average expense ratio of 0.5%, which means you're paying about $50 for every $10,000 you invest into SHLD. So it's an ETF definitely worth looking into buying and holding for the long term, and especially as a hedge during market corrections, which can sometimes last a good long while. This brings me to the last one, which is GPIQ, or the Goldman Sachs Nasdaq 100 Income ETF. Now, some of you might be scratching your heads and wondering why this ETF might be a good one to purchase or buy more shares of during a market correction. Now, the main reason why is because the yield actually increases as the underlying index falls. So as of right now, the dividend yield for GPIQ is currently just under 12%, and these dividends are paid out monthly. So even though the underlying index, in this case the Nasdaq 100, is falling and the price of GPIQ may be going lower and lower, you're still getting that around 12% in dividends paid out every single month. Plus, you're able to scoop up shares of GPIQ at a low price, so when the market eventually does recover, your yield on cost stays fairly high, and you continue to get those nice dividend paychecks. Now, this fund is also still very small. Its assets under management is roughly 525 million, with a below average expense ratio at 0.29%. So GPIQ continues to be one of the best monthly dividend ETFs to buy in both bear or bull markets, because of how much income you're receiving every month. So let me know what you guys think of these 3 ETFs and whether or not you'd consider owning them for the long term, and especially in the type of market that we are in right now. And I will see you all next time.